Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. In this video, I will share with you my 5 biggest mistakes and lessons I learned in investing and how you can avoid them. I will give you at least one personal example for each mistake. When it comes to investing, I always believe we can learn the most from our mistakes than our success. So here are the 5 biggest mistakes I made in investing. Hopefully you can avoid most of them. Mistake number 1. Not staying invested in great companies. I will give you personal examples of investing in Apple stock and Tesla stock. Mistake number 2. Not investing in what I know. I will talk about ARK ETFs here. Mistake number 3. Fear of missing out. I will give you a personal example investing in Pinduoduo stock here. Mistake number 4. Be greedy when others are greedy already. You will learn about why I made a small mistake investing in Zoom stock. Mistake number 5. Timing the market instead of investing for the long term. You will see some of my past real-life gains here. If you like this video, hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing analysis videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we will be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Take a look, let's start. The first biggest mistake I made in the past was not staying invested in great companies during large market corrections. I will give you 2 personal examples here. The first stock I bought was Apple during the 2008 global financial crisis. The 2008 global financial crisis was the worst recession since the Great Depression. The S&P 500 index dropped as much as 57.7% from its peak in October 2007 to its bottom in March 2009. Many people call it the Great Recession. The 2008 global financial crisis was way worse than the current pandemic crisis that started in 2020. In comparison, during the pandemic crisis, the S&P 500 dropped about 34% from its peak in mid-February 2020 to its bottom in late March 2020. Now, I knew Apple is a great company because I always use Apple products, such as using the iPod to listen to music when I was still in school. Back then, I also knew the iPhone was replacing the BlackBerry smartphone. But the problem was that I was new to investing. In school, I studied financial planning, economics, accounting, security analysis, and portfolio management. Later on, I even took the level 1 CFA exam. But none of these courses helped me in real-life investing because most of them are based on economic theories. And in my opinion, they are not practical in real-life investing. So guess what I did? I sold my Apple shares when I saw the stock drop below my cost because I was afraid the stock would drop further. I was fearful when the market was very fearful. I knew Apple is a great company because I always use Apple products, but I did not educate myself in stock investing first before investing in Apple. When I saw the stock price increase above my cost, I was very happy because I was making money. But when the stock price dropped below my average cost, I was scared it would drop further. So I sold my Apple shares. It was my biggest mistake. Now, if I held my Apple shares from 2009 till now, it will increase by as much as 4,588%. This means my Apple stock could have become a 46-bagger if I held the stock until now. And this return does not even include Apple's dividend payout every quarter. Luckily, I did buy back my Apple shares much later at a much higher price, and I've been holding it since then. The biggest lesson here is to always hold shares of outstanding businesses, even when there's a large market correction, because they will eventually recover and reach new highs due to their increasing corporate earnings. Recently, I also made the mistake of selling my Tesla shares when the company was below 100 billion in market cap during the peak of the pandemic in March 2020. I knew Tesla is a great company that is far ahead of most EV manufacturers and traditional car manufacturers. But again, same as my first investment in Apple stock, I let my emotions control my thinking. I was afraid Tesla stock would drop further during the pandemic in March 2020. Now, Tesla's market cap is at 787 billion. This means my Tesla shares could have become a 7-bagger if I held the stock until now. I have to kick myself for repeating the same mistake again. The lesson here is to stay invested in great companies for the long term, even throughout market corrections. Great companies always recover and perform very well in the long term because of their increasing earnings, increasing cash flows, superior products and services, strong fundamentals, and increasing economic modes. Great companies tend to become multi-baggers in the long run because of their increasing earnings. The second biggest mistake I made was investing in stocks and ETFs I did not fully understand. Let me share my personal example of investing in ARK ETFs. If you look at my portfolio here, you can see I made the mistake of investing in ARK Genomic ETF and ARK Innovation ETF because I bought them when they were near their peaks in January and February this year. I was simply fear of missing out because I saw Cathie Wood's ARK ETFs did an amazing job in 2020. For example, Cathie Wood's ARK Innovation ETF increased 148% in 2020 and her ARK Genomic ETF increased 224% in 2020. Here's one important lesson I learned in investing in ETFs. Past performance does not guarantee future results. So we should not look at an ETF's past performance and think that the ETF will have the same performance in the future. A much better approach is to look at the ETF strategy, see if it's a very good strategy that makes sense, and understand what the ETF invests in. I made the mistake of not understanding what ARK ETFs invest in. For example, if you look at ARK Genomic ETF holdings list here, you can see it has 54 biotech and genomic related stocks. I do not understand any of these biotech stocks in this list here. Biotech, healthcare, and genomic stocks are outside of my circle of competency. Also, if you look at this ARK Innovation ETF holdings list here, you can see this ETF has 46 stocks. I do not understand half of these stocks here. Cathie Wood's ARK Innovation ETF and Genomic ETF did very well in 2020. Most of the stocks she picked benefited a lot from the current pandemic and the current low interest rate environment. But here's the problem. As interest rates start to increase and as the US Fed starts tapering its $120 billion monthly bond purchase program, I believe ARK ETFs will not perform as well as before because ARK ETFs invest in many disruptive companies that are still losing a lot of money every quarter. Most of these disruptive companies do not have positive earnings and positive cash flows yet. They have to rely on debt to finance their growth. This means they will be impacted the most when interest rates start to increase in the US. I just realized this problem after studying US Fed monetary policies and analyzing how higher interest rates, higher inflation rate, and the upcoming US Fed tapering will impact US stocks, including ARK ETFs going forward. The important lesson here is to always invest in what you know and do your own research first before investing in stocks, ETFs, real estate, or any type of investment. If you always do your thorough research first when you plan your vacation, it will make sense to also do a lot of research first before investing in anything. For example, if you look at my growth stock portfolio here, you can see many stocks such as Apple, Amazon, Alphabet, MasterCard, Mercado Libre, Microsoft, and Visa have become multi-bagger stocks. I have done a lot of research on them. Most of them have become multi-bagger stocks because of their increasing earnings. The third biggest mistake I made was fear of missing out. This is also known as FOMO. Here's one personal example. I made the mistake of investing in Pinduoduo stock here. I was fear of missing out on this stock even though I knew Pinduoduo's business model is not as profitable as Alibaba and JD.com's. Pinduoduo was losing a lot of money and burning a lot of cash every quarter when I invested in the stock. The stock was also near its all-time high. The only good thing about Pinduoduo was that its monthly active user was growing much faster than Alibaba and JD.com. I actually made this stock analysis video to show why Pinduoduo stock was substantially overvalued compared with Alibaba stock and JD.com. So why did I still buy Pinduoduo stock if I knew the stock was exceedingly overvalued? It was simple. I was fear of missing out because Pinduoduo stock was performing much better than Alibaba and JD.com. Before the current Chinese regulatory crackdown started, that has caused most Chinese tech stocks to drop more than 50% this year. Here's the important lesson I learned after investing in Pinduoduo stock. Stock valuation does matter. Before investing in any stocks, including growth stocks and small cap stocks that have the largest growth potential, I believe it's important to calculate and estimate the stock's fair intrinsic value so we can invest when the stock is undervalued and avoid it if it's substantially overvalued. This is why I started talking about the intrinsic value of stock in my most recent stock analysis videos here. Here is another important lesson. Instead of following overhyped stocks in social media, or following what Cathie Wood is investing, or following what Warren Buffett is investing, or following what the biggest hedge fund managers are investing, I believe a much better way is to invest in what we know and find great companies around us that we always interact with every day. For example, most people use products and services from Apple, Amazon, Facebook, Google, and Microsoft every day. I believe these are outstanding businesses with increasing earnings and increasing economic moats. They are my top holdings in my growth stock portfolio here. They have also made the largest gains in my growth stock portfolio because of their increasing earnings and their increasing economic moats. The fourth biggest mistake I made is similar to the mistake I mentioned earlier. I call this mistake be very greedy when others are already greedy. This is the opposite of what Warren Buffett recommends. Warren Buffett always says, be fearful when others are greedy and be greedy only when others are fearful. The best time to invest in stocks is when others are very fearful because most stocks will be much cheaper and more undervalued. The worst time to invest is when everyone is very greedy because most stocks would be much more expensive and more overvalued. Here is a personal example. Zoom stock did very well in the first 3 quarters of 2020 because it benefited the most from the current pandemic. The stock surged as much as 730.86% between January 2020 and October 2020. The pandemic forced everyone to stay at home and to use video conferencing apps such as Zoom to connect with their friends, families, and colleagues. Now, there was a large pullback after Zoom stock peaked in mid-October 2020. I made the mistake of investing in Zoom stock after it peaked in the middle of October 2020 because I thought the large pullback was only temporary. I was very greedy when the stock was near the peak because I thought Zoom stock would continue to grow exponentially throughout 2020 and 2021. Cathie Wood also invested in Zoom. This is why I don't follow what the most popular investment managers are investing in now. I invested in Zoom stock because I thought Zoom's business should continue to do well even after the pandemic is over, since many people will continue to work from home and use Zoom for work. But here's the problem. After I invested in Zoom stock, I realized Microsoft Teams was becoming a huge threat to Zoom's video conferencing business. Many large enterprises prefer to use Microsoft Teams instead of Zoom because Microsoft's cloud services tend to be much more secure than Zoom, and because Microsoft Teams is well integrated with Microsoft's existing Office applications used by many large enterprises. After that, I sold my Zoom stock at a very small loss of $486. Zoom stock did drop much more afterward. The important lesson here is not to be greedy when everyone else is very greedy about a stock. In my opinion, it's best to stay away from overhyped stocks, especially the stocks everyone talks about in social media, or the stocks that the super investors such as Warren Buffett and Cathie Wood have recently invested in. By the time Warren Buffett and Cathie Wood invest in a stock, the stock is likely already overvalued because many other investors will have copied them already. My fifth biggest mistake is that I tried to time the market many times in the past, anticipating the next large market correction and selling stocks that would be worth much more by now if I did not sell them. For example, let me show you my realized gain and loss history here for the past 2 years. I can only go back to a maximum of 2 years. If you look at the history here, you can see all the realized gains and losses here for the past 2 years. Luckily, most of them are realized gains. I made the mistake of selling many outstanding businesses such as Shopify, AMD, Nvidia, Amazon, Salesforce, Facebook, MasterCard, Mercado Libre, Nasdaq, C Limited, Square, Tesla, TSMC, and Visa. If I didn't sell these shares, my growth stock portfolio here would be much larger by now. So here's the important lesson I learned. Instead of timing the market, if the stock is an outstanding business with increasing earnings and increasing economic moats, I believe it's much better to stay invested in it for the long term and hold through all the market ups and downs so it can become a multi-bagger in the long run. This is how we can grow a stock portfolio to over 7 figures over time. Outstanding businesses always perform very well in the long run because of their increasing earnings, increasing economic moats, superior products and services, and strong fundamentals. All these lessons and mistakes are based on my personal experience investing for the past 12 plus years. I hope you find these lessons very useful and practical. I also hope you can avoid many of these investing mistakes I made in the past. If you like this video, hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing analysis videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check Check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we will be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Thank you for watching this video. This is Victor from the Intelligent Investor channel, and I will see you in the next video.